Coming up in today's show, stocks trade mixed after bond yields spike up, after retail sales grew higher than expected, an update on the Middle East conflict, are bonds now cheap, NVDA and chip stocks fall on the back of more export bans, and a look at some Q3 earnings. Welcome back to the Click Capital Daily Market Show, everybody. And if you're new to this channel, welcome. Don't forget to hit that subscribe button as I make this show every day after market close. And thank you to everyone who has recently joined the channel and for all your support and comments. I've been really pleased with how far it's come thus far. And so on this Tuesday in Wall Street, it was a bit of a mixed day out there. We can see that in the heat map with this checkered breadth, with NVIDIA leading the way down almost 5%. Laura will get into that one a bit more on the charts. Saw a little bit of a pullback in healthcare and utilities, with some strength in the financials and energy and oil and gas stocks holding up pretty good. First, let me just get you updated on what's going on over in the Middle East, with the conflict between Israel and Gaza taking a turn for the worst, with a hospital just being bombed, apparently claiming the lives of over 500 people, with both sides pointing the finger at each other for who is to blame. And so Israel is still bombing the Gaza Strip, and there's still fighting going on around the border there. And this is with US President Joe Biden on the way to Israel as we speak. And so tensions are still running high in the region. And we've still got other major officials like Secretary of State Antony Blinken stepping up diplomatic efforts to try and stop this from spilling over, as the Biden administration really doesn't want oil spiking above $100 a barrel going into election next year. That could really upset the economy and their chances of being re-elected. So he's going to do everything he can to prevent that from happening, including planning to ask Congress for a $100 billion funding package for Israel and Ukraine, as he keeps his focus and your tax dollars on securing the borders of other countries, and a continued boon for all the defense stocks out there. However, that could easily get out of his control if the other Iran-backed Islamic extremist militant group, Hezbollah, on Israel's northern border decides to step in and open a new front, with Israel's defense force, the IDF, spread a bit thin in the southern area of the country. And that could happen if Israel moves into the Gaza Strip trying to take full control, as Iran is already warned them against that and could possibly give the green light to Hezbollah to go ahead with attacking Israel at full scale, in which things would really spill over then, and no doubt oil would be spiking above $100 a barrel. And this is already at a time when financial markets are becoming a little bit more fragile, with ripping rates, sticky inflation, high federal and consumer debt, and at a time when a lot of people are already struggling to pay for food and energy. This is definitely not what Biden wants going into election next year. However, for now, the US consumer is holding up pretty good, and we can see that in the latest retail sales data we got today, coming in a lot higher than expected, 0.7% growth month over month, well above the street's estimates of 0.3, and is a little surprising in the face of that higher gas price we've been getting over the last couple of months. And there's a chart of the month over month change in monthly US retail sales going back to the start of last year, and September last year actually saw a decline of 0.1%. So this one of 0.7 is up a lot year over year. And you can see over the last 6 months, it's all been positive. So whilst not huge growth, the consumer is still hanging in there. And that data just reinforces the higher for longer theory on interest rates. The chances of them being cut anytime soon still very low, with some even saying the markets are misreading the Fed and that the central bank could still easily raise rates again, as they could still have room to do so with a strong economy, low unemployment, and core inflation still double their target. And with that data today, we've seen a bit of a strong repricing of the probabilities the Fed does increase rates, now sitting at almost 50-50 in January, with a 49.5% chance they hold, 41% chance we'll have a 25 basis point hike by then, and the market even given an 8.8% chance we'll have a 50 basis point hike by then. So the market's been really undecided this last month or so whether we do get another hike, and it's been flickering back and forth. However, we keep getting this strong economic data, and the big ones, inflation, they keep ticking up a little bit as they have done the last couple of months. Then we're going to see increased probabilities that the Fed does do another hike, potentially in December or in January. And the market keeps just pushing out the odds that the Fed funds rate stays where it is now for longer and longer into next year. And we can see more evidence of that in government bond yields today, with the 2-year yield actually breaking out to a new cycle high, above 5.2%, a level we haven't seen since the middle of 2007, 16 years ago, and similar price action in the 10-year government bond yield, back up close to cycle highs, sitting at 4.83%. And if we don't see things escalate in the Middle East, I think there's a good chance we see 5% over the coming days and weeks here, as the economy is holding up pretty good, and there's a lot of upside momentum in bond yields. If Hezbollah was to really enter the war and start attacking Israel in full scale, there would be a bit of flight to safety to US treasuries, and that would see yields fall back down. However, that's not a good scenario for the stock market either, because if that were to happen, we'd likely see crude rip up to new highs as well, above $95 a barrel, and upset the consumer and keep upside pressure on inflation as well. So either scenario is bad for stocks. And one of the few places to hide out throughout all this mess could be in gold. Now trading back above its 50-day and just kind of calling up a bit above $1,900 an ounce. We did come up and flirt with all-time highs earlier in the year around late April, early May, with it getting $4 within that all-time high of $2,089. And it's hard to see things getting completely fixed overnight in the Middle East. The risk is to the upside, and that should keep a strong bid in gold for the time being. However, we've got a top JP Morgan strategist saying that bonds look cheap amid the Israel-Hamas war, and that the recent jump in bond yields is problematic for investor sentiment and for the economy, making their levels unsustainable. He goes on to say, our outlook is likely to remain cautious as long as interest rates remain deeply restrictive, valuations expensive, and the overhang of geopolitical risks persist. Lags behind in the impact of high rates are longer this time, but we believe most of the negative effects are still to come. So he's saying these high rates are going to eventually filter through the economy, hurt things, and the Fed will probably have to cut next year, and that should put a good bottom in the bond market, which has been in its worst bear market throughout its entire 250-year history. However, we've still got some others, like the CEO of the largest asset manager in the world, BlackRock chief Larry Fink, saying long-term investors should be plowing 80% of their portfolios into stocks and other hard assets. He even said investors with high tolerance for volatility could even have 90 to 100% of their portfolio in equities. He said investors have good opportunities to put their cash into artificial intelligence and robotics. He went on to say you've got to have a 10-20 year view. I'm a hopeful person. I believe that in 10 years, 20 years, humanity will be in a better position than it is today. With that view, I want to own hard assets. I want to own equity. I want to be a part of this economy. On the other hand, we've got some saying that there are signs that the stock market euphoria is mirroring past bubbles and could end badly for investors. With investment advisor Smead Capital saying in our conversations with investors, we are pointing out the totality of this financial euphoria episode. Due to incredibly low interest rates for a long time, we think the history books will look back at this time period as a combination of the 1636 tulip mania in Amsterdam and the South Sea bubble of 1720. According to Smead, the tulip boom and bust mirrors the market's excitement in crypto, meme stocks, IPOs, SPACs, which soared in 20 and 21, then plunged last year as interest rates climbed. We also got the street's biggest bear, Mike Wilson of Morgan Stanley, standing by his call that stocks are due to slump 10% by January, and he gives 4 points to back up his call, with the first being that market breadth remains very weak, consumer confidence is declining, S&P 500 is technically stuck between resistance and support, with most stocks putting in a double top pattern from their July highs, and this chart here of the S&P 500, excluding the top 7 names, has fallen to its lowest level since late 21, and just took out new lows relative to the S&P 500 itself. That's why Mike Wilson is maintaining his year-end target of the S&P 500 of 3,900. We also saw NVDA take a tumble today after the Biden administration said it would be tightening its restriction on exports of artificial intelligence chips to China. The company said it doesn't expect a meaningful impact on its near-term financial results. It has talked about the long-term downside effects of these economic cold wars and is not in favor of it. However, the US government is looking to restrict China's military capability by using advanced American tech. And we're getting more of the big banks' earnings rolling in, with Bank of America reporting a profit rise of 10% from a year ago. The second largest US bank got a boost from higher interest income and strong performance from its Wall Street unit. The CEO said we did this in a healthy but slowing economy that saw the US consumer spending still ahead of last year but continuing to slow. And that's pretty much what a lot of CEOs have been saying, that they're doing okay but things are slowing down a bit. And so that was about an 8% beat on what the street estimated they'd earn, and pretty good price action there today, finishing up 2.3% on volume and getting back above its 50-day for the first time in a few months. Contrasting that was Goldman Sachs, which saw its profit decline after they continued to retreat from trying to get into consumer banking. Its earnings were $2 billion, down 33% from a year ago. Part of that was $500 million write-down on a specialty lender they agreed to sell. And so even though the street was expecting that and they came in line with expectations, the market still sold them off 1.6%. We also just had United Airlines report. They came in with a slight beat, but sounded the alarms on what's going on in Israel. And so even though they beat EPS estimates by 8%, the market's still selling them off almost 5% after hours as I speak. Not only does wars make people want to hop in a plane less and travel, it also keeps the upside pressure on their biggest variable cost, that is oil, filling up their jets. And that's why we've seen the airline companies sell off pretty hard the last couple of months as we've seen oil rip. And it doesn't look like oil's going to get cheap anytime soon. The big one this week is Tesla. in which we'll get their third quarter earnings after market close tomorrow. They did come in recently with deliveries less than expected, still growing about 20% year over year though. Wall Street will really be looking at their gross margin, which has also pulled back in recent quarters after they've been decreasing prices, but it's still well above industry average. Then they'll be also looking for some guidance, how many cars they're producing and expected to deliver next quarter. And the stock is trading right around the average price target that Wall Street has for Tesla at $250 a share. And just looking at the chart of Tesla, it's been going sideways for a few months here, currently at $254 a share, and this could have an impact on the market tomorrow after close, so we'll be watching that one. So make sure you come back to Click Capital tomorrow for my analysis of that. And so the street is expecting Q3 earnings as a whole to come in basically flat, maybe a little bit down on last year. We've had 3 consecutive quarters of year-over-year earnings declines, and Wall Street's expecting that to go back to growth come Q4 and into next year. Expecting earnings to increase 8-9%, going into 12% year-over-year next year. However, like JP Morgan's quant team says, that might be a bit over-optimistic, as we still haven't seen the full impacts of the most aggressive Fed rate hiking cycle in history. And just a quick look at what factors have been performing well this year. It's the quality factor. Quality stocks like the Apple, Microsofts is the winning factor out of the 6 top factors this year. And the worst performing factor has been low volatility. Stocks like utilities, consumer staples, which have been sold off pretty hard the last couple of months due to fears of weight loss drugs and rising rates with utilities and other low volatility stocks like that. Over to economic data today. So inflation data out of Canada came in a little weaker than expected. Actually had a little bit of deflation month over month, down 0.1%, and their year over year rate increased a bit lower than expected as well, 3.8%. There's American retail sales coming in at 0.7%. That was the big one from today that got yields moving up. Industrial production came in a bit higher than expected as well. A few hours, we've got some data coming out of China, inflation data out of UK tomorrow, and some housing data from the States as well. Fear and greed index seems stuck at 35, and still not much action from corporate insiders. Just looking at the main US stock indices, you can see the S&P 500 stalling out here, just below its 50-day VWAP. As the Nasdaq was the loser today, coming off a bit, and a bit of a bounce up in smalls. Might be trying to put in a bottom here on a bit of a divergence. And it was a mostly positive Tuesday. Looking across international stock markets as well, with most indices finishing a little bit higher, and a little bit of a pop up in the VIX index. Got to 18.5 this morning before finishing a bit below 18, and options still priced about 4.3% higher than realized volatility. It was a real quiet day in the options market, just under 35 million contracts traded, 51% of them calls. And just looking at Max Payne in SPY for this monthly OPEX on Friday, it's a little bit lower at 432. So that gravitational pull from option dealers is a little bit lower than where we are now. Another pop up in short-term breadth, 63% of stocks above their 20-day average. We can see we're getting a little bit overbought here above the buy-sell band in short-term breadth. So market might be getting a bit ready for a breather here. There was an improvement in breadth on the NYSE and new lows versus new highs. However, a similar trend of late in the Nasdaq. Still more stocks hitting lows than highs, 65 to 35 today. There's the growth versus defensive sector spread, still trading sideways, and a bit of a pullback in the tech versus small cap spread after that's been on a tear this last 2 months. And there's gold still ripping higher versus treasuries. And on the back of that strong retail sales data we got today, there's the spread of inflation protected treasuries versus regular treasuries, ripping higher to a new year-to-date high, and a sign the market still thinks inflation is sticky. And we've still got international 10-year government bond yields moving higher in tandem with the states as well, which is keeping downside pressure on bond prices like TLT, coming back down to lows, but starting to put in a technical divergence here and a bit of volume coming in as well. So this thing's looking to find some support here. And those higher yields are helping the dollar to hold up just above 106. And commodities are doing remarkably well in the face of that stronger dollar, except for markets like copper, which is still in a downtrend and pretty weak. But we've still got agricultural commodities like orange juice and sugar breaking out to highs. Over to stock sectors, was a bit checkered out there today. And just looking at my sector trends table indicator, we've only got 3 sectors green across the board. Energy, oil and gas, back to outperforming as they have done for the last couple of months, and communications with a few of those tech stocks. And we've also got 2 sectors that are red across the board. That's robotics and automation and global jets, the airlines. With the next weakest sectors being clean energy, biotech and consumer staples. A little bit of a bounce back on above average volume in the cannabis ETF here today. And there's semiconductors, the losing sector today on the back of those further export bans of chips to China. Regional banks was the winning sector today, up over 2%, back above its 50-day for the first time in a few months. And there's a look at the strongest sectors, energy and oil and gas, almost getting back up to those highs from early last month. And the interest rate sensitive sectors like real estate came off a bit today, down 0.5%, and utilities as well, stalling out a little little bit at their 50-day. There's BlackRock still a little weak after their earnings, and JP Morgan just pulling back a little bit after their earnings on Friday as well. Looking at the big guys like Apple and Microsoft were a little soft today. We've got earnings coming out of them in a week. And there's the chart of NVDA, which came off almost 5% today and a bit of a spinning doji. And we seem to have this solid roof of resistance around $480, $500 a share. Meme stocks were also mixed today. Got a bit of a bounce back in recent IPO. Footwear maker Birkenstock, and I think this one could be setting up for a good short, is a little richly valued at $7.5 billion. And other IPOs have been performing weak of late, like Instacart and ARM. And that's a typical pattern you'll see after IPOs. After the initial buzz wears off, a lot of insiders and others will sell into it and it'll go a bit weak for a few months before bottoming out. So I think the same thing could happen with Birkenstock, and it just rejected a little bit off its VWAP since it started trading last week. The defense contractors are still holding onto their price gains pretty well, and those beaten down snack food companies are still trying to find a bottom here, as is General Motors and other beaten down undervalued old economy stock Verizon. Banks did well today, and Charles Schwab defending its good performance from yesterday's earnings. Okay, so back to the S&P 500, sitting just under 4,400 here. Seemed to reject it a little bit off the 50-day VWAP. Still think there's a chance we could come up and complete this gap fill above 4,400 and maybe run into a bit of overhead resistance around this 4,450 level where the market's turned before, and we've got a bit of a over-the-top trend line as well. And like I said, the tail risk for the market still remains, with the conflict in Israel spilling over to their northern border with Hezbollah, which would cause oil to spike, and that should probably upset the stock market. However, if that doesn't happen, we've still got that upside momentum in bond yields, and that's not good for stocks either. So best case scenario for stocks is things calm down in the Middle East, we get some softer inflation data causing yields to pull back, and Q3 earnings keeps coming in above expectations. If all that were to happen, then we could get a bit of a breakout above this 4450 level towards 4500, and who knows, maybe even test those highs around 4600. However, there's still a lot of headwinds for this market, and I wouldn't be surprised either if we break down through this trend line we've had since the October low last year, as breadth is still weak and most sectors moving averages are still pointing down. That's all for this Tuesday. Thanks very much for sticking with Click Capital, and make sure you come back tomorrow afternoon for Tesla's earnings. See you then, guys.